KOSPI market shock, deciphering the tech sector divergence. All right, let's just dive straight into this massive market movement. When indices drop this sharply, it's incredibly easy to let emotions take the wheel. But in this explainer, we're cutting through the noise. We're going to look strictly at the hard numbers, the core data, and market microstructure from May 19, 2026. We need to figure out exactly how these different technology layers are driving investment flows right beneath the surface of the KOSPI.
Now, waking up to a market heat map that is just completely drowning in red, human nature tells you the sky is falling, for sure. Visually, it looks like a full-scale institutional exit, like everyone is just packing up their capital and fleeing the market entirely. But as we know, the visceral shock of a massive drawdown rarely tells the whole story, especially once you actually start digging into where that capital is flowing.
And, well, with the KSP dropping a shocking 3.25% in a single day, yeah, it definitely felt like a full-blown panic. A move of over 3% is a major shock to the system, and it immediately sets off alarm bells across global trading desks. The headline number is scary, but from an investment perspective, we have to pause and ask, are we looking at a broad macroeconomic collapse here, or is there a specific structural engine driving this decline? Actually, the reality is hidden right there in the concentration. That massive 4.55 trillion KRW foreign sell-off, it was highly targeted at just two traditional memory tech giants, Samsung Electronics and SK Hynix. We're not looking at a scenario where foreign investors are indiscriminately dumping all Korean assets. Instead, it's a highly targeted extraction of capital from a very specific technology layer, large-cap memory semiconductors. And that is a crucial distinction for anyone trying to understand the market's current tech narrative. When you break down the numbers, it completely shatters that illusion of a broad panic. Samsung and SK alone accounted for a staggering 67.5% of total foreign net selling. Just think about that for a second. Over 2/3 of the entire foreign outflow for the session came from just two companies. The data proves this was a hyper-focused event, literally an isolated pressure point in the memory technology sector, rather than some systemic failure of the broader market. So, to understand why this happened, we've got to look at the catalyst. This targeted drop was actually triggered by the Seagate CEO publicly questioning the memory industry's ability to meet demand. That fundamental industry comment echoed across markets, hitting names like Micron, Western Digital, and Applied Materials in the prior U.S. session. Over in Korea, this fundamental shock acted like a tripwire, triggering a mechanical, non-arbitrage program sell-off of 4.82 trillion KRW. Basically, once the computers took over, they executed a ruthlessly structured decline based purely on a shifting outlook for legacy memory tech. But here is our massive canary in the coal mine. Individual retail investors stepped up and absorbed 2.13 trillion KRW of Samsung shares on a net basis. They single-handedly soaked up 84% of the foreign outflow within that session, holding Samsung to just a 1.96% decline compared to the broader index's 3.25% drop. Panic-driven selling simply doesn't produce organized buyer formation at this massive scale. This absolutely proves it was a structured move, an organized transfer of risk, not a distressed market collapse. Which brings us to the absolute most fascinating takeaway for tech investors, a brutal sector divergence. While traditional memory bled out, AI fabless technology decoupled entirely. Fadu, an AI semiconductor company, actually gained 9.10% on the very same day, seeing 50.5 billion KRW in heavy foreign buying. Think about that. A foreign investor aggressively adding an AI semiconductor position while simultaneously dumping memory exposure in a single session. That is a massive flashing signal. It shows that capital is sharply differentiating between AI tech and legacy memory tech. In institutional circles, we actually call this a structured partial outflow. Money isn't fleeing the country in fear. It's executing a surgical rotation away from one specific technology layer. The capital is staying engaged, but it's shifting its focus. When you see institutional players making these highly selective maneuvers, you know you're witnessing a strategic repositioning based on technological influence rather than a macro-level retreat. Let's validate this real quick in the derivatives market. Foreign investors dumped equities in the spot market, moving 6.29 trillion KRW out, but simultaneously, they bought 518.9 billion KRW in index futures. If they were truly abandoning the market, they'd be shorting futures to clear their books, not buying them. By buying futures, they're maintaining their directional exposure to the market. The position isn't closed, it's just being restructured. And we can bulletproof this theory with currency data. the Korean won weakened sharply, rising 14.4 won to hit 1,507.3 against the dollar. Normally, you'd assume a global flight to the US dollar, right? But the DXY, the global dollar index, actually fell by 0.3%. This completely rules out a global risk-off event. It proves beyond a shadow of a doubt that this capital movement was a Korea-specific asset restructuring. Further proving that smart money was shopping, not fleeing, capital flowed heavily into the defense sector. Hanwha Aerospace gains nearly 5%, driven by 22.8 billion KRW in foreign net buying. Foreign money was actively rotating into specialized sectors, capitalizing on U.S.-Iran geopolitical friction. They were hunting for calculated opportunities, absolutely confirming they were not running away from the broader market. But, we can't just ignore the macro storm clouds. The MOVE index, which is the ultimate tracker for bond market fear, spiked nearly 8% in a single session to hit 86.07. While equities were enjoying a structured rotation, the bond market was flashing warning signs of severe macro tension. Sector rotation alone cannot fix this underlying uncertainty, and it's a metric we definitely have to take seriously. That macro tension makes tonight's U.S. data drop absolutely critical for risk management. We start with a read on the consumer via Home Depot's earnings, followed quickly by pending home sales to see if mortgage rates are finally breaking housing demand. But the main event is Christopher Waller's speech. His tone on inflation and rate cuts will directly dictate the bond volatility we just looked at, and ultimately, it's going to set our hedging costs. As investors, you need a definitive validation scorecard for tonight. We must see NASDAQ futures hold above 29,100 to keep this AI memory divergence thesis alive. If it breaks below 28,885, this structured rotation quickly devolves into a broad semiconductor panic. But your most critical metric is Nvidia's performance relative to Micron. If the market is truly differentiating AI tech from legacy memory, Nvidia must show relative strength while Micron carries the pressure. We've tracked the capital, decoded the algorithms, and proven the precise decoupling of AI from traditional memory chips. If Nvidia holds strong tonight while Micron bleeds, this new tech hierarchy is fully confirmed. The market is aggressively evolving its definition of tech leadership. So I'll leave you with the only question that matters. Based on the hard data we just explored, is your portfolio properly positioned for the great AI memory divide?